Welcome back to our monthly real estate market update at Prize Capital Real Estate. I'm Jason Prize, the founder of Prize Capital Investment Research. As we move into March 2025, median home prices for contracts pending are down nearly 3% compared to this time last year. And I know what you're thinking. How is that possible? The simple answer? When the cost of borrowing is higher, fewer buyers can afford these prices. It all comes down to supply and demand. Demand is way down. Higher mortgage rates have pushed many buyers out of the market. But supply is still historically low. We're not seeing a wave of new listings flooding the market. That's especially true in Myrtle Beach. In many areas, even if buyer activity slows, homes don't have to be fire sales. They just have to be priced right for the buyers who can afford them. But here's the catch. If inventory keeps growing at this pace, that shortage could be gone by next spring. And that raises a big question. Will home prices start falling even faster? Right now, home prices are slightly lower than last year, but the pace of depreciation is slowly accelerating. Pending home prices are currently 3% below last year. The 50-year national average for home price appreciation is around 5% per year. If inventory fully returns to normal levels, we could see prices drop by 5%, maybe even 10% by 2026. The big wild card here is mortgage rates. In 2024, when mortgage rates dropped close to 6%, buyer demand surged. Home sales picked up. Prices climbed. 6% seems to be a critical threshold. So, if we spend any real time near 6% this year, I expect we'll see inventory tighten, sales increase, and home prices rebound. So, where do things stand right now? Let's take a look at the latest data for the Myrtle Beach housing market as we kick off March 2025. This week, the number of unsold single-family homes in Myrtle Beach ticked up by almost 1%, bringing the total to just over 944 homes. That's 32.6% more homes on the market than this time last year. This is exactly the supply expansion we've been watching unfold. But there's an interesting twist. Mortgage rates are actually lower today than they were a year ago. Let's rewind to last year. In 2023 and early 2024, mortgage rates climbed aggressively, reaching 7.5% by May. As rates surged, inventory exploded, with more and more homes sitting on the market. By the end of May 2024, there were 12% more homes on the market than a year prior. This year, rates are slowly trending down. That means inventory is still building, but at a slower pace. We're now forecasting 18% inventory growth by the end of 2025. If you joined our webinar last week, we talked about a big shift in inventory trends across the country. Texas and Florida led the nation in inventory growth last year, but not anymore. California and Arizona are now seeing the fastest inventory expansion. California and Arizona now have 45% more unsold homes than a year ago. Texas has just 31% more homes on the market, a noticeable slowdown in growth. Certain markets, like Texas and Florida, were highly sensitive to rate spikes. When mortgage rates surged, unsold homes skyrocketed. Looking at the chart, we're tracking 8 years of inventory trends in Myrtle Beach. At the far right end, you'll see that inventory is starting to inch up for spring. Last year, there were only 700 single-family homes on the market. In 2019, there were 1,200 homes available in February. If mortgage rates stay elevated for the rest of 2025, we could see inventory return to 2019 levels by next spring. When you look at the inventory chart, you'll notice 3 clear phases. First, the pre-pandemic, last decade, mortgage rates were falling, and the lower they went, the more people wanted to own real estate. As ownership increased, unsold inventory declined. Second, the pandemic boom, ultra-low rates supercharged demand, and buyers snapped up every bit of available inventory, pushing supply to record lows. Third, the post-pandemic correction. 3 years of rising rates have now led to 3 years of rising inventory. And now we're approaching a fourth phase, the return to normal inventory levels. By next spring, the number of unsold homes in Myrtle Beach could finally be back to its pre-pandemic norm. But as we get closer to that point, it raises a big question about home prices. Will they hold steady, or start to decline? For inventory to grow significantly, we need more sellers. But right now, the numbers aren't showing a major influx. On a 3-month delta this week, there were only 56 new unsold single-family home listings in Myrtle Beach. Another 75 new listings went directly into contract. These were immediate sales. That brings the total number of home sellers this week to 131. That's actually fewer sellers than this time last year. Even though buyer demand is sluggish, we're not seeing a huge wave of sellers. Unsold new listings are down 1% from a year ago. Fewer immediate sales mean more homes are sitting on the market longer. However, the overall number of new listings is still lower than 2023. So in the chart, you'll see that new unsold listings have remained pretty flat compared to last year. I still view any growth in sellers as a good sign. It signals a more balanced, healthier housing market. However, we're always on the lookout for any surge in sellers that could quickly change the supply-demand balance. So far, there's no sign of a major shift. One thing we're keeping an eye on is whether federal policy changes or economic uncertainty lead to higher unemployment and eventually more home sales due to financial distress. Let's say a major spike in unemployment happens this spring. That doesn't immediately translate to a flood of new listings. People don't sell their homes the week after losing their jobs. They collect unemployment, look for new work, and try to stay financially stable. Only after 6+ months of struggling to find work, homeowners may start missing mortgage payments. Months later, distressed sales start showing up in inventory. If this pattern plays out, a major wave of new listings wouldn't hit the market until 2026. But unlike past cycles, homeowners today are sitting on ultra-low mortgage rates. In a typical recession, people who lose their jobs might sell their home and rent to lower their costs. That doesn't work this time. Many homeowners have rates well below today's market rates, and selling could actually put them in a worse cash flow position. So even if we see job losses and economic uncertainty, the impact on housing inventory may be much smaller than expected. What to watch moving forward? Total inventory levels are near the point where home prices might have to adjust downward, but we're not seeing any sign of a major seller surge yet. Each week, we'll keep measuring the data closely to see if that changes. For now, the market remains stable on the supply side, with no flood of sellers in sight, but as always, we'll be watching the trends carefully. Meanwhile, with more homes sitting unsold, we're seeing home prices just barely dip below last year's levels. Home prices are about 3% lower now than they were in March 2024. This week, the median price for contracts pending came in at $424,995. That's down slightly from last week and 3.2% lower than the same week last year. How does this compare to national trends? On a national level, home prices are still higher than last year, but the growth rate is slowing. In Myrtle Beach, prices increased 1.4% in 2024, but as of early 2025, they're down 1.7%. So while home prices aren't in free fall, appreciation is compressing. Looking at the chart, you'll see the blue-green line for 2025 at the left side, where we measured this week's median contracts pending price of $424,995. Typically, pending home prices climb in spring, peaking around June before cooling off in the second half of the year. Right now, home prices are slightly lower than a year ago, but not by much. So what will it take for prices to turn positive again? More buyers entering the market. Lower mortgage rates to increase affordability. Mortgage rates will play a huge role in where home prices go next. If rates spike back up, let's say inflation jumps and the 10-year Treasury yield rises, then mortgage rates could climb back to 7.5%. If that happens, home prices would likely drop further. On the other hand, rates have actually been inching lower for the past month. If we get lucky and rates slide closer to 6%, demand should pick up, helping stabilize home prices. Looking at the gold line for 2024 in the chart, you'll notice something interesting. When mortgage rates briefly dipped near 6% last September, buyer demand jumped. That demand was strong enough to keep home prices elevated through Q4 2024. If rates trend lower again, we could see the same resilience in home prices this year. For now, we'll keep watching buyer activity and mortgage rates to see if prices can find support, or if they'll continue their slow decline. This week, both home prices and home sales dipped, signaling that buyer demand remains sluggish in early 2025. On a 3-month delta, we counted 60 new pending single-family home contracts in Myrtle Beach, 56 new condo sales. That's 5% fewer sales than last week and 11.5% fewer than the same week in 2024. Spring is typically when home sales start climbing, so we should see a rebound in next week's data. But here's the issue. The growth we've been hoping for just hasn't materialized yet. Looking at the chart, what we really want to see is the blue-green 2025 line consistently coming in above the gold 2024 line, a sign of home sales growth. But that's not happening. As a result, there are now 476 single-family homes in contract across Myrtle Beach. That's 18% lower than a year ago. Last year, home sales gained momentum in Q4, but that growth has now stalled. One major factor at play here is mortgage rates. Rates have been easing down slightly over the past month. They are lower than they were at this time last year, but they're still hovering near 7%. So far, we haven't seen any real signs of home sales growth in 2025. Coming out of Q4, we expected demand to pick up, but that demand will likely only return if rates start to approach 6% again. The leading indicator, percent of homes on the market with price reductions, dropped slightly this week, down 24 basis points to 42.5%. That's still excessively high. A normal market sees 30 to 35% price reductions. This means that more homes than ever in recent Marches have taken a price cut. That's a clear statement about buyer demand versus available supply in early 2025. We're facing weak home sales and pricing for the next few months at least. If mortgage rates stay around 7% or higher through spring, expect more price cuts and rising inventory. If rates ease closer to 6%, we could see demand return faster than supply. So that's all the data we have time for today. We'll keep tracking these trends closely, so stay tuned for next month's update. If you're looking to make sense of this ever-changing real estate market, we're here to help. Call us or visit our prestigious office at Prise Capital in Myrtle Beach, South Carolina, where we'll guide you through everything you need to know about the housing market. You can also visit our website at prizecapitalrealestate.com, where you can now sign up for a free Prise Capital Real Estate Research account. With this account, you'll gain access to weekly local market data. And again, I can't stress enough that this live data comes out weekly with insights tailored to your area. Whether you're buying, selling, or advising, we'll help you dive into your local market and make informed decisions. Click the link below to get started. Thanks for tuning in, and we'll see you next time.